Welcome back to Charged Alpha, where we take one stock from the S&P 500 and go deep. I'm Hudson.
And I'm Lana. Today we're talking about a company that has absolutely had it with 2025 so far.
That's a hell of an opener.
I mean it. In the span of 14 months, this company got hit with the largest healthcare data breach in American history. Its CEO was assassinated on a Manhattan street. And then in April, the stock absolutely tanked, down 22% in a single day, because of an actuarial miscalculation that nobody saw coming.
Wait, all that was the same company?
The same company, UnitedHealth Group, and somehow despite all of that chaos, we're here today asking whether it might actually be one of the best opportunities in healthcare right now.
That's a pivot. Okay, I'm in. Let's talk about UnitedHealth. So first things first, what is UnitedHealth Group really? Is it just an insurance company?
That's the trap a lot of people fall into. Most investors think of UNH as the big health insurer, and yeah, there's a health insurance business called UnitedHealthcare. That did about $298 billion in revenue in 2024.
That's massive.
It's massive. But here's the thing, that's less than 75% of the total company revenue. Last year, UnitedHealth did $400.3 billion in total revenue. The other $100 billion? That comes from something called Optum.
Okay, so Optum is what exactly?
Optum is basically healthcare services and technology. It's a pharmacy benefits manager. It's a network of employed physicians. It's data and analytics. It's the plumbing underneath the whole healthcare system.
Walk me through the actual structure, because that sounds confusing.
So you've got UnitedHealthcare, the insurance division. They sell health plans to individuals, to employers, to Medicare and Medicaid. That's your traditional health insurer business.
Right?
Then you've got Optum, which has three main parts. One, Optum Rx, the pharmacy benefits manager. In 2024, they managed $133 billion in drug spending. Two, Optum Health, their doctors and clinics division. They employ about 90,000 physicians. And three, Optum Insight, which is basically healthcare data and intelligence. That's an $18.8 billion revenue stream.
So they own the insurance, they own the pharmacies, they own the doctors.
And they own the data analytics on top of it all. Exactly.
That sounds either brilliant or terrifying, depending on how you look at it.
Both. That's literally both. And that's why UnitedHealth is the center of a DOJ antitrust investigation right now. But we'll get to that.
Okay, so before we go down that road, the headline numbers, how big is this company?
In 2024, they served 50.1 million members across all their businesses. Market cap is roughly $251 billion. The stock trades at a forward PE of 15.80, and they've paid out or increased their dividend for 17 consecutive years. That's an $8.84 per share annual dividend, giving you about a 3.13% yield.
So the headline story is huge healthcare company, diversified income streams, reliable dividends. But then everything went sideways last year.
Everything went sideways. Let's talk about why.
Before we get to the disasters, I want to understand the real value proposition here. Why did UnitedHealth even build Optum? What's the strategic thesis?
It's the vertical integration play. Think about it this way. Traditionally, health insurers are middlemen. They collect premiums, they pay claims, they take a spread. It's a fairly low-margin business, usually 2 to 5% margins.
That doesn't sound great.
It's not. But if you own the insurance and the pharmacy and the doctors, you can make money at multiple levels of the value chain. And more importantly, you can optimize the whole system.
What do you mean optimize?
Example, if you're just an insurer, someone takes a drug, you pay for it at whatever the market price is. If you own the pharmacy benefits manager, you have leverage over manufacturers. You can negotiate better prices. And if you also own the doctors, you can guide patients toward generic drugs, away from unnecessary expensive treatments. You can integrate electronic health records across the whole system. You can do predictive health analytics, catch somebody's diabetes before it gets serious.
So the thesis is vertical integration creates efficiency, and you capture margins at every layer.
Exactly, and in theory it works. Optum Health was doing $105 billion in revenue in 2024. Optum Rx was massive, $133 billion. Optum Insight was the crown jewel, this analytics business with incredible moats.
Past tense?
We'll get there. But first, let me give you the real thing that made this strategy brilliant. Insurance is a bad business long term because you're betting on people getting sick. It's a negative expected value business if you get the actuarial math wrong,
I've never thought about it that way.
right? So the smarter play is to own the assets that reduce illness, own the doctors, manage the pharmacies, do preventative care. That's a better business. That's what they were building.
So the business model made sense. The execution just hit a wall.
A few walls. Let's talk about the actual financials first.
Okay, so paint me the revenue picture from 2020 to now.
So in 2022, UnitedHealth did $324.2 billion in revenue. In 2023, that was $371.6 billion. In 2024, $400.3 billion. That's strong, consistent growth, roughly 8 to 9% year over year.
Nice.
Then 2025 hits and revenue was $447.6 billion. That's another $47 billion in growth.
That sounds even better.
It's not. Because here's what happened. That revenue growth came at the worst possible cost. There's a metric in health insurance called the medical care ratio, or MCR. It's the percentage of revenue that gets spent on actual medical care.
Lower is better, right?
Much lower is better. If you do $400 billion in revenue and your MCR is 85%, you're spending $340 billion on medical care and keeping $60 billion. But if your MCR is 90%, you're spending $360 billion and keeping only $40 billion. The math compounds.
Oh,
In 2024, UnitedHealth's MCR was 85.5%. That's good. That's healthy. By the end of 2025, it was 89.1%.
that's a roughly 3.6 percentage point swing.
Exactly. And in the fourth quarter of 2025 alone, it hit 92.4%.
Wow,
Yeah, and to make it more painful, their adjusted earnings per share in prior years were around $27. But in 2025, full-year adjusted EPS guidance was only $16.25.
that's a 40% cut.
Exactly right. And that's what caused the stock to crater. What caused the MCR to blow up like that? 3 big drivers. 1, the cyber attack. 2, the Medicare Advantage miscalculation in April. And 3, the corporate and leadership chaos that made it hard to focus. Let's start with the cyber attack.
So in February 2024, there was a cyber attack on Change Healthcare. But Change Healthcare isn't UnitedHealth, right?
It was owned by UnitedHealth. UNH acquired Change Healthcare back in 2022, and in February 2024, they got hit by a ransomware attack from a group called ALEV, also known as Black Cat.
How bad was it?
192.7 million people were affected. That's roughly 60% of the U.S. population.
Oh my God.
Yeah, medical records, claims information, patient data, all of it got exposed. The attack shut down claims processing and prior authorization across the U.S. healthcare system for weeks.
What does that actually mean in human terms?
Hospitals couldn't verify insurance. Pharmacies couldn't process prescriptions. Doctors couldn't get approvals to do procedures. The entire machinery ground to a halt.
That's not just a data breach. That's a systemic risk event.
Exactly. And UnitedHealth had to pay a ransom, $22 million, to try to unlock the data. They ultimately spent $2.87 billion in total to deal with the breach. Incident response, notification, forensics, customer compensation, infrastructure upgrades.
And that hit their earnings.
Massively. Their GAAP earnings per share in 2024 were $15.64, dragged down by all the cyber attack costs.
But the cyber attack was a one-time event, right? Painful, but fixable?
Right? Insurance, you adjust reserves, you pay out, you move on. Painful, but not a strategic problem. Then came something that was much harder to ignore.
December 4th, 2024.
Brian Thompson, CEO of UnitedHealthcare, the insurance subsidiary, was walking into the Hilton in Manhattan for an investor conference. Someone shot him dead.
And this wasn't random.
It wasn't random. Luigi Mangione was arrested. He had a manifesto that talked about rage against health insurance companies for denying claims. And then the internet went bonkers. You had people celebrating the assassination. A national conversation erupted about whether insurance companies are extractive, whether they deny life-saving care for profit.
Did that conversation have merit?
I think parts of it did. But the financial story here is that this was an absolute PR nightmare for UnitedHealth. Congress opened investigations. States started talking about tighter regulation. The narrative shifted completely.
They went from operational issues to being the villain in a national crisis.
Completely. Trust is part of a healthcare company's moat. When you lose it at that scale, it matters.
What happened to leadership?
Brian Thompson was replaced in January 2025 by Tim Noel as UnitedHealthcare CEO. But at the corporate level, Andrew Whitty, who was CEO of the whole company, resigned in May 2025. And here's the remarkable part. They brought back Stephen Hemsley, who had been CEO from 2006 to 2017.
They went back to the old guard.
Which tells you how destabilized the organization was. You don't recall a retired CEO unless you're genuinely in crisis. And so there's a new CEO trying to stabilize operations right when the Medicare Advantage bomb goes off.
Walk me through what happened in April 2025.
UnitedHealth is the largest Medicare Advantage insurer in the country. Medicare Advantage is the program where Medicare contracts with private insurers to manage care for seniors. The insurer gets a fixed payment per senior per month. If they manage care efficiently, they keep the difference. If seniors use way more care than expected, the insurer eats the loss.
So it's a risk transfer to the private company.
Exactly. And the profitability depends entirely on getting utilization assumptions right. How much healthcare will seniors actually use?
And UnitedHealth got it wrong.
Catastrophically wrong. They were predicting seniors would use a certain amount of healthcare. What actually happened was seniors used roughly double what was expected.
How is that possible?
A few theories. Maybe they underestimated the severity of the population they attracted. Maybe there was coding inflation where doctors started coding diseases differently. Maybe post-COVID deferred came back all at once. Whatever the cause, on April 23, 2025, they announced they were suspending their 2025 earnings guidance.
The stock dropped 22% in one day.
In one single day, that wipes out tens of billions in market value, and it signals to the market we have no visibility into our core business right now.
And they're still in recovery mode.
Still, their 2026 guidance is for revenue to actually decline to $439 billion. MCR target is 88.8%. That's still above their historical comfort zone of 83 to 85%.
So the company's saying, we'll make less money next year, but we think we can fix the underlying problem.
That's the gamble. And while all this is happening, there's another sword hanging over their head, the DOJ.
The DOJ is investigating UnitedHealth for antitrust violations. What are they worried about?
Vertical integration. The argument, if you own the insurance, the pharmacies, the doctors, and the data analytics, you can suppress competition, raise prices, and make it impossible for smaller players to survive.
Is that a real concern?
I think it is. If you own the pharmacy benefits manager, you have leverage over what drugs get covered. If you own the doctors, you can steer patients away from competitors. If you own the data, you have information advantages nobody else can replicate.
And the DOJ is in discovery phase now, 2026.
Right? Taking depositions, requesting documents, building the case. This could stretch into 2027 or 2028.
What's the worst case?
Forced divestiture. They could require UnitedHealth to spin off Optum entirely or divest the insurance business. Either way, you're destroying the integrated model that was the whole thesis.
And that's the real tail risk.
Because the combined entity is worth more than the pieces. You take it apart, you lose the synergies, you lose the leverage, you're back to being a middleman insurer with mediocre margins.
But it's speculative right now.
Very speculative, but it's real. Okay, despite all of that, there are reasons to believe in this stock. Let's talk about the moat.
Explain the moat to me.
UnitedHealth is the market leader in literally every business they operate in. Largest health insurer, largest pharmacy benefits manager, one of the largest employer-owned physician networks in the country, and the data to go with it.
How durable is that?
Very. In healthcare, scale creates efficiency. When you're processing billions of claims, you learn how to do it efficiently. When you're managing millions of patients, you understand population health patterns. When you're negotiating with pharmaceutical companies, you have leverage because you control access to 50 million people.
Couldn't a competitor build that?
In theory, sure. In practice, Elevance Health is half the size, CVS Aetna is still integrating, Cigna is focused on employer benefits, Humana is niche on seniors. None of them have the breadth or the data infrastructure that UnitedHealth has.
So the gap is hard to close.
And physician networks have network effects. The biggest network attracts the most patients, which attracts more physicians, which grows the network. That flywheel is hard to replicate. And structure is durable. It doesn't disappear overnight, even when the company is having a rough year.
Okay, bear case, bull case, let's go. Why does this stock stay broken?
3 reasons. First, the Medicare Advantage model might be permanently impaired. If senior utilization stays elevated and doesn't revert, you're stuck with bad contracts you can't reprice. You bleed money for years.
That's brutal.
Second, antitrust. If the DOJ forces a divestiture, you lose the synergies that made this company special. And if you're selling assets at a bad time, in a bad market, you might not even get fair value.
And third,
Regulatory backlash. The assassination created a national story around claim denials. Congress is paying attention. If new regulations limit what an insurer can earn, or how they use patient data, or how they can deny care, that structurally compresses margins forever.
so bear case, broken model, broken up, overregulated.
And in that scenario, you're waiting years to find out if recovery is even possible.
Bull case, why is this a generational opportunity?
3 reasons. First, the market overreacted. A 22% down day is a panic selling event. Panic creates opportunity. The stock hit a 52-week low of $234. That's down 60% from all-time highs. That's a massive discount.
But the current price is $280. We're already off the lows.
Right, but you're still down 18% over 5 years, while the S&P 500 is up 14% annualized. That's a 32 percentage point gap. You're buying a quality business at a meaningful discount to the market.
What's reason 2?
The integrated model, once it recovers, is genuinely superior. OptumRx is growing at 16%. Optum Health, once the strategic exits are complete, has tremendous potential. The combined business makes more money than the pieces would separately.
And it's a compounding advantage once it works again.
With a 17 consecutive year dividend growth streak as your floor, you're getting paid to wait. Right now, that's a 3.13% yield. If the stock recovers, those dividends look even better in hindsight.
What's reason 3?
Valuation is genuinely cheap. A forward PE of 15.80 on a company with durable scale advantages and a dividend is not expensive. The S&P 500 trades at around 20 times forward earnings. UnitedHealth is at 15.8 times, a 20% discount. Fear is driving that discount, not fundamentals.
And fear doesn't last forever.
It doesn't. If the Medicare Advantage issue stabilizes, earnings recover, multiples expand, and you get capital appreciation plus the dividend. That's a solid total return thesis.
Where does Wall Street stand?
The consensus is bullish but split. Analyst price targets range from $255 on the low end to $440 on the high end. The average consensus is around $361 to $397, depending on the source. That implies 30 to 40% upside from current levels.
And the overall rating?
Buy consensus from 24 analysts, which sounds strong, but you have to adjust for the fact that Wall Street analysts are almost always bullish on stocks they cover.
Fair enough. What does the valuation actually imply?
Here's my thinking. If they normalize the MCR to around 88 adjusted, you could recover to $20 to $23 per share. At 13 to 15 times earnings, which is a slight discount to the market given the risks, you'd get a stock in the $206 to $345 range. Call the midpoint $300ers.
So from $280 today.
Modest upside to the midpoint, bigger upside if the MCR normalizes faster and the antitrust risk fades, and the 3% dividend yield while you wait.
It's not a home run. It's a quality business at a fair price.
After going through one of the worst years in its history. That's actually the setup that value investors love.
Let's bring it home. UnitedHealth Group, what's our summary?
UnitedHealth is America's largest healthcare company. $400 billion in annual revenue, a durable moat built on scale, data, and vertical integration. And right now, it's beaten up.
Really beaten up.
3 crises in 14 months. The largest healthcare data breach in history, the assassination of the CEO, and a Medicare Advantage utilization shock that cut EPS guidance nearly in half. The stock is down 60% from its highs.
But
the moat is intact. The dividend is growing, the business is recovering, new management under Stephen Hemsley is focused, and the valuation reflects fear, not necessarily permanent impairment.
the risks are real, though.
Absolutely real. Antitrust litigation could force a breakup. Regulatory backlash could compress margins permanently. and the Medicare Advantage issue could take longer to resolve than management hopes.
So who is this for?
Patient investors with a 3 to 5 year horizon who want exposure to the largest player in U.S. healthcare at a significant discount to historical multiples, with a dividend to reward the wait.
If you want to dig deeper into UnitedHealth Group or any other S&P 500 name, head over to chargedalpha.com. That's where we post full research notes, model updates, and follow-ups on every stock we cover. We'd love to have you as part of the community.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.